Welcome back, everyone. In today's explainer, we're going to dive right into something that can literally make or break your portfolio, mastering the incredibly complex rules of investment taxation. Because let's be real, we all absolutely love watching our investments grow, right? But here's the catch. A high before-tax return honestly doesn't mean a thing if you just end up handing a massive chunk of it straight over to the IRS. So let's figure out how to maximize those after-tax returns and avoid those common traps.
The U.S. tax code can definitely feel like a labyrinth. So here's our roadmap for today. We've got 1, the investment tax bite; 2, interest and dividend income; 3, capital gains and losses; 4, real-world tax forms; and 5, passive income and losses. Okay, so I want to kick things off by having you think about this. Why on earth do 2 completely identical investments yield wildly different cash returns in your actual pocket? Well, the answer almost always comes down to taxes. More specifically, it's about the timing of your tax payments and whether you're getting slammed with ordinary tax rates or kicking back and enjoying those sweet preferential tax rates. You see, those 2 factors are the hidden variables that are just silently eating away at your profits.
All right, let's jump straight into Section 1, the investment tax bite, before tax versus after tax.
To really wrap our heads around this, rather dry tax math, let's anchor it to real life. Meet our 2 investors. First up, we have Courtney. She's a 40-year-old architect who just came into a $100,000 inheritance. Now, her whole focus is on buying and holding assets for her future goals. Mainly, she's trying to save $50,000 for her son's college in 8 years, and another $50,000 for a vacation home in 5 years. Then we have her uncle Jeb. Jeb is 65, he just retired, and he is laser-focused on the tax bite of selling off his existing stock assets. Why? Because he wants to fulfill a lifelong dream of buying a sailboat. Because, what's retirement without a boat you constantly have to throw money at, right? So their goals are totally different, and as we're going to see, their tax strategies need to be drastically different too.
Moving right along to Section 2, interest and dividend income, Courtney's portfolio. Let's follow Courtney as she decides where to actually park that inheritance. She's looking at portfolio income, so things like interest and dividends. Now, if she decides to buy a corporate bond, she needs to be incredibly careful about this sneaky little rule called original issue discount, or OID. Say she buys what's known as a zero coupon bond, which is just a bond issued below its maturity value. It doesn't pay regular interest, right? Well, bam, she hits the OID trap. The IRS actually requires her to amortize that discount and pay ordinary taxes annually on that income. Just think about that for a second. She is paying taxes every single year on income, even though she is receiving exactly 0 cash payments to actually cover the bill. So here's a massive takeaway for you. Always check if your discounted bonds have phantom income. There's no way you want to be paying taxes on cash you haven't even received.
But wait, let's contrast those brutally high ordinary interest rates against preferential dividend rates. If Courtney decides to invest in dividend-paying stocks instead, she could potentially enjoy tax rates of 0%, 15%, or 20%. Sounds great, right? Well, there's a catch. To actually secure these qualified dividend rates, she absolutely must meet a super strict holding period rule. She has to hold the underlying domestic stock for more than 60 days during a very specific 121-day window surrounding the ex-dividend date. And I mean it. If she holds it for just 59 days, she is right back to paying those higher ordinary tax rates on her dividends. Talk about a costly mistake. Okay, let's pivot to Section 3, capital gains and losses, Jeb's sailboat dreams. So we're transitioning over to Jeb's journey now. He needs cold, hard cash for his sailboat, which means he's got to navigate the somewhat wild world of capital gains. And the absolutely crucial point here is the netting process. Let's break down Jeb's 4 stocks. First up, the short-term stuff. He takes an $8,000 short-term gain from his stock C, and he uses it to offset an $11,000 short-term loss from stock D. Simple enough, right? That leaves him with a net short-term loss of $3,000. Okay, next he looks at his long-term assets. He takes this massive $35,000 long-term gain he got from stock A and offsets it with a $10,000 long-term loss from stock B. That gives him a $25,000 net long-term gain. Finally, he combines the 2 categories, the whole shebang. By subtracting that $3,000 short-term loss from his $25,000 long-term gain, Jeb walks away with a $22,000 net long-term capital gain to go fund his sailboat. And here is the kicker. Because it's net long-term, it gets taxed at those much lower preferential rates. But wait a second. Jeb might think he's an absolute genius and try to game the system here. He might think, hey, I'll just sell a losing stock just for the tax deduction and then immediately buy it right back because I still believe in the company. Nope. He cannot do this. Enter the infamous wash sale rule. This rule strictly disallows a capital loss deduction if an investor repurchases substantially identical securities within a 61-day window. That is 30 days before the sale, the day of, and 30 days after. If he tries to pull this off, the loss isn't recognized at all. Instead, it just gets trapped inside the basis of his new stock. Total bummer, for sure.
Now for Section 4, Real-World Tax Forms, Grounding the Math.
You know, it's one thing to do all this math on a whiteboard, but it's a completely different beast to actually report it to the IRS. So let's ground this and talk about the real-world forms Jeb has to use to report that $22,000 net gain. We kick things off with Form 1099-B. This is the official documentation from his broker detailing his $40,000 proceeds from Stock A. The broker sends this to both Jeb and the IRS at the end of the year. It proves exactly how much cash he received, along with acquisition dates and his cost basis. Basically, the IRS already knows what he did, so Jeb has to make absolutely sure his personal forms match up perfectly. From there, we move over to Form 8949, Part I, to see how this builds out his short-term transaction history. Part I is specifically for reporting those short-term capital gains and losses, assets held for 1 year or less. Here, Jeb officially records the sales of Stock C and D. This is where he explicitly shows the IRS that $3,000 net short-term loss that we calculated just a minute ago. Next up, he tackles Form 8949, Part 2. This section is all about reporting long-term capital gains and losses, so assets held for more than a year. This is the exact spot where he nets out Stock A and Stock B to reveal that sweet $25,000 long-term gain to the IRS.
And this is where it all really comes together, like a giant puzzle. All those totals from Form 8949 funnel straight into Schedule D, summarizing all his capital gains and losses for the tax year. It matches our earlier math perfectly, finalizing his $22,000 net long-term gain. Schedule D is basically the ultimate summary page. It's what tells the IRS exactly how much of his income gets to be taxed at those beautiful, much lower preferential rates.
All right, home stretch. Section 5, Passive Income and Losses, the final tier.
Let's step into the really advanced tier of investing here, passive income. We're talking about things like rental properties and limited partnerships. Imagine our architect Courtney decides to invest $10,000 as a limited partner in a passive design business. Let's say that business generates a $15,000 loss in her very first year. Well, she can't just go and deduct that full loss against her ordinary architect salary. No way. Her deductions actually face 3 sequential hurdles. First, the tax basis limit, meaning her operating losses are limited to her adjusted investment basis. Second, the at-risk amount limit. She's limited to her actual economic risk. And finally, the passive activity loss limit, meaning losses can generally only offset other passive income, not her ordinary salary. So, because she only put in $10,000, $5,000 of that loss is just immediately suspended right out of the gate by the basis limit.
But hey, as with literally everything tax-related, there are exceptions. What if Uncle Jeb decides to buy a rental condo instead of a sailboat? If he actively manages it, meaning he owns at least 10% of the property and gets involved in management like approving tenants or handling repairs, he might actually bypass those strict passive limits we just talked about. The rental real estate exception allows active participants to deduct up to $25,000 of rental losses directly against their ordinary income. It's a huge deal. However, and this is absolutely crucial, he has to watch his overall income. This incredible benefit actually phases out by 50 cents per dollar for an adjusted gross income between $100,000 and $150,000. So careful planning is 100% mandatory here. The source material for this explainer honestly puts it perfectly. Taxes are levied on investment income. Thus, it would be unwise to make an investment without considering the tax cost. Think about it. A 10% return that gets slapped with a 37% ordinary tax rate might actually put less money in your pocket at the end of the day than a 7% return taxed at that sweet 15% long-term capital gains rate. So I'm going to leave you with this final thought. Take a good hard look at your own portfolio. Before you file your next return, are you absolutely certain you aren't paying more than you legally have to? Taxes are inevitable, for sure, but paying more than necessary, that is entirely optional. With some structured planning, a little loss harvesting, and a solid understanding of the rules we covered today, you can keep a whole lot more of what you earn. Thanks so much for joining me on this explainer, and I will catch you in the next one.